Hello everyone, welcome back to my channel Tutelage A Guide to Learner. Here this is Sriparna. Hope all of you are doing great. In my last session we have already discussed the stock and flow variables and basic market structure and two sectors and three sectors model of circular flow of income. So today we will going to explain another most important concept of economics, that is money and national income. So if you have missed my previous session, please go and check my description box and my first comment where the session link is already shared. Okay, so let's turn on the next slide. So here we can see some topics which we will discuss today. So the first one is definition of money, the second one is function and characteristics of money, third one is types of money, and last but not the least, that is concept of national income. So learner, let's begin the session and move on the first slide. So in this slide we can see the definition of money. So do you have any knowledge, learner, about money? I think you all have that knowledge, what is money and etc. So yes, learner, money is a commodity which helps in transaction. Okay, so helps in transaction. Clear? Involving goods and services from one to another person, such as notes, currency is the example of money. Okay, so now going to the definition, here we can see the Crowther's definition. So according to the Crowther, money is defined as anything which is generally accepted as a means of exchange, acts as a measure and store of value. So in a simple sentence we can see money is a medium of exchange. Clear? So basically money circulates from one person to another person, one country to another country, which facilitating trade only. So do you know, learner, what is the official currency of India? Yes, you were right, that is a rupee. So rupee is the official currency of India. So now move on the next slide where we can see some characteristics of money. So the first characteristics of money, that is the durability. Okay, so durability means it lasts over time. Okay, so it refers the material used to make money must last for a longer period, okay, without losing its value. For example, vegetables, fruits are not good money because they lose their value quickly with the time because they perish also. Clear what is the actual meaning of durability? And it is clear the durability is one of the main characteristics of money. So now going to the second one, that is the portability part. So portability means if good money requires the portability characteristics, because it means if people can carry money from one person to another, one place to another place, then we can say the material has the portability power. So that's why it is one of the important characteristics of money. So now going to the third one. So that is the divisibility. So divisibility means money is divisible by any number. So when we are talking about qualities of money, so then it is very important to remember these characteristics, that is divisibility. So if someone wants to buy a smaller unit of commodity, then divisibility of money can make it possible. For example, the price of potatoes for 1 kilo, that is 40, and you have 10 rupees only. So that's why you can purchase 250 grams of potatoes. So why? How is it possible? Because 1 kilo's potatoes price is 40 and the price of the 250 grams potatoes, that is 40 by 4, that means 10. Okay. So price or money is divisible. So good money have the divisibility power. So that's why divisibility is one of the most important characteristics of money. Now going to the fourth one, that is the uniformity. Uniformity means all have the same monetary value. All rupees, all 100 rupees have same value. In fact, nobody can distinguish between the two currency notes right out of the mint. So this is called the uniformity. So in a simple sentence, all 100 rupees or 200 rupees or 500 rupees have the same monetary value. So now going to the fifth one, that is the acceptability. Clear? So good money always have the acceptability power. So it requires the acceptance to all without any hesitation. So everyone must be able to exchange the money for goods and services, and it has an inherent quality of acceptability. Okay, so now going to the last one, that is the limited supply. So it must be available in limited supply. Too much would decrease its value also. So now going to the next slide. I think the characteristics of money is clear to everyone. So let's move on. So here we can see four functions of money. The first one is medium of exchange. So before going to the explanation, we have to discuss the barter system or barter economy. So that's why we will go to the next slide where we can see the definition of the barter system. So now let's move. So here we can see the definition of barter system. So what do you mean by a barter system, learner? Barter system basically refers to the system of exchange where goods and services are exchanged directly for other goods and services. For example, we can say a farmer may exchange their production, that is wheat, with the cloth produced by a weaver. Clear? So basically barter system is the exchange of goods directly for other goods. Clear? So now going to the previous slide. So now we can discuss the first function of money. So for the first function of money, that is medium of exchange. In previous days, we all know that we have barter system of exchange, and where we can exchange one goods and services directly for other goods and services. So that's why there was creation of problem. So money actually solves the problems which was created by the barter system. It acts as an intermediary between a buyer and seller. It must be widely accepted method of payment also in different markets like labor market, capital market, etc. Clear? So now going to the second function, that is unit of account. So money acts as a unit of account also, because it is a ruler by which other values are measured. For example, an accountant may charge 25,000 rupees to file your tax return. So that 25,000 money can purchase any kind of things. Okay, so that's why it acts as a common denominator, an accounting method that simplifies thinking about the trade-offs also. So now going to the third function, that is standard for deferred payments. Okay, so it must serve as a standard of deferred payment also. So if money is usable today to make purchases, so it must also be acceptable to make purchases today, and that will be paid in the future also. So standard of deferred payment is what allows us to buy any goods and services today and pay in future, like any type of loan like car loan, home loan, etc. So you can purchase car or home today, but loan that will be paid in future. So that's why this is one of the main characteristics of money. So money serves as a standard for deferred payment. So now going to the fourth function of money, that is stored of value. So learner, we all know that the barter exchange system refers to the exchange of one goods and services directly for other goods and services. For example, a shoemaker is trading shoes for accounting services. So, but he or she risk having her shoes go out of style. Its value will decrease after few years. So, it is not the good store of value. You know, you don't need to spend it immediately because it will still hold its value same the next day or the next year also. In an economy with inflation, money loses their buying capacity, okay, buying power, but money remains same. So now going to the next slide. So here this is the slide for barter system. So we have already discussed it earlier. So now move on the next slide. So here we can see some differences between barter and money economy. So we all know what do you mean by a barter system or barter economy. So the economy based upon the barter exchange, that means goods and services exchange, which is known as barter economy. So that means the economy, when the economy using goods and services as a system of exchange, so this is known as barter economy. And when the economy using money as a system of exchange for carrying out any type of economic transactions, that is known as money economy. And that is the basic differences between barter and money economy. So now move on the next slide. So here we can see types of money. So money is of two types. The first one is currency and second one is deposit money. And currency is of two types also. The one is currency note and second one is currency coins. So now move on the next slide. So here we can see another most important concept of basically macroeconomics, that is the national income. So let's start the explanation. So national income is an indicator of the nation's economic activity, and it can be calculated by three methods: income method, expenditure method and value added method, but these are not part of the syllabus 1, so that's why we will discuss it in near future. So now going to the definition of the national income. So according to the Dornbusch and Fisher, national income is a value of final goods and services produced by domestically owned factors of production within a given period of time. So within a given period of time is the most important group of words in every definition of national income. So national income is basically the total monetary value which are produced by nations during a period of time, and it is basically an aggregate of earnings also. So the progress of a country can be determined by the growth of the national income of the country. I think the definition of national income and the concept of national income is clear to everyone. So now going to the next concept, that is per capita income. So per capita income of a country is the average income of the normal residents of a country in a particular year. Okay, so per capita income is indicated by the total national income divided by total number of population of the country. So I think this is very easy and it is also clear to everyone. So now move on the next slide. So here we are going to discuss some concepts of the national income: GDP, NDP, GNP and NNP. So at first we have to know what is the full form of GDP. So the full form of GDP is gross domestic product. Okay, so what do you mean by a gross domestic product? It basically refers the total money value of all final goods and services produced within a geographical boundaries of a country during a given period of time. Okay, so the total monetary value of all final goods and services which are produced within a country's border by citizen or non-citizen of the country. Okay, now going to the second definition, or before going to the second one, that is the NDP. So at first we have to know the formula of GDP. Okay, so the formula of GDP, that is C plus I plus G plus X minus M. This is the formula of gross domestic product. So what is the C, I, G and X minus M? C for consumption of the country, of the consumption of the uh, goods and services which are produced basically within a country's border. Now going to the I, that is investment. G for government expenditure, and last one, that is the X minus M. X means export, M means import. So export minus import, that is equals to net exports. So net exports is included in the GDP calculation. So now move on the next slide. So here we can see the another definition, that is the net domestic product or NDP. So the full form of NDP, that is net domestic product. Okay. So NDP accounts for a capital that has been consumed over the year in the form of housing, vehicle or the machinery deterioration or depreciation. Basically, in a simple sentence, NDP is equals to GDP minus depreciation cost. I think this is clear. Okay. So now move on the next slide. So here we can see the formula of the net domestic product, that is GDP, total GDP of the country minus depreciation on a country's capital assets only. Okay. So now move on the next definition. That is gross national product, and this is the full form of GNP. Clear? So GNP refers to the money value of total production of final goods and services produced by the nationals of a country during a given period of time, generally a year. Okay. So it refers to the total money value of final goods and services by a country's citizen only, both domestically and abroad. That is the basic differences between GDP and GNP. GDP refers to the total money value, total monetary value of final goods and services within a country's border by citizen and non-citizen of the country. But in GNP, it refers to the total monetary value of the production which is produced by a country's citizen, both domestically and abroad. Okay. So I think this is clear what is the basic differences between GDP and GNP. So now move on the next slide. So here this is the formula of the GNP. So GNP is equals to GDP plus X for exports minus imports. M means imports. So at first we have to know what is the export and what is import. So export is basically goods, sending goods to another country for sale. So that means goods are produced domestically but sold to different countries' citizen. Clear? And it is included in GNP measurement. Here we can see also. So income of the, so export is basically income of countries, sorry, X is income of country's citizen, because all goods are produced domestically but then sold to the different country's citizen. So that's why it is the income of the country's citizen. So that's why it is included in GNP measurement. So learner, now going to the import part. Okay, so what is import? So import basically outflow of funds. Okay, that means payments to sellers residing in another country. So that's why it is not included in GNP calculation. Okay, so import or M is the income which is received by the foreign nationals from within the country. Okay, if export is equals to import, so GNP is equals to GDP. Similarly, in a closed economy, X minus M or net exports is 0, then GDP is equals to GNP. So do you I think you all know what do you mean by a closed economy. So if you don't know, so please comment me on my comment section. Okay, so now going to the next. So here this is the another concept, that is net national product. So this is the full form of NNP. So now going to the definition. So NNP is obtained by subtracting depreciation value from GNP. So NNP at factor cost or national income is equals to GNP minus depreciation cost, and when GDP minus depreciation cost, this is called NDP. That is the basic differences between NDP and NNP. I think this is clear to everyone. So learner, we are done for the today's session. I will come with a new session very soon. Till then, stay tuned. Please do like, share, comment and more subscribe to my channel. Happy learning. Thank you.